ladies and gentlemen. Again, a very warm welcome to you on Business Today Television. We are smack in the middle of the week on Tuesday. Markets are showing signs of a bit of profit booking, but all is well as far as the broader structure of this ongoing correction or incipient bull market is in place. To discuss this and a lot more, we are now joined by Mr. Sandip Bansal. He's the Deputy Chief Investment Officer at ASK Investment Managers, one of the earliest companies to offer tailored portfolio management services for ultra HNIs. Mr. Bansal manages about 4,000 crore rupees in offshore AIFs, domestic funds, and of course, three schemes which are ASK Growth, ASK Light, and of course, the third one which has been recently launched, which is ASK Special Opportunities Portfolio. A very good morning to you, Mr. Bansal, and a very warm welcome on Business Today Television. Characterize for us the sentiment on Dalal Street at this point of time. We have a GST rejig in the pipeline, tariffs to the extent of 50% coming in on Indian merchandise exports from the US, and of course, a slowing economy, absent FIIs, and a stagnant first quarter. How do you see markets at this point?
Good morning, Shairendra. Thanks a lot for having me on the show. Yes, the global environment is uncertain. The tariffs on India, which would be applicable likely from tomorrow at 50%, is unexpectedly high. Eventually, at some point of time, we would expect the tariffs on India to go down. Exactly how we traverse that path is currently unknown, but it does seem quite unlikely that India will remain one of the highest tariffed nations in the world by the US. Our historical ties with the US do not justify these kind of tariffs. So at some point of time, we would expect these to come down to more reasonable levels. Our broader peer group has tariffs which are substantially lower than ours. Having said that, in the interim, would there be disruption? The answer is yes. Our trade or exports with the US to the US are around $80 billion. Maybe 55% of them, or roughly around $45 billion, would get impacted due to this. Our exposure at ASK in our portfolios to these sectors is very minuscule. Our portfolios are more domestic oriented, and domestic economy is where we are relatively more positive and bullish upon. Growth in the first quarter, as far as earnings are concerned, have actually not been that bad. Yes, one could argue that expectations themselves were muted, but those muted expectations have been largely met. The current quarter, or Q2 FY26, is likely to be impacted because of the impending GST rate cuts. There will be a postponement of demand. Anyways, this is a relatively seasonally weak quarter for many sectors of the economy. But having said that, we would expect a very good pickup in Q3 onwards. And the reasons for that, Shailendra, are likely to be the cut in GST rates, the benefits of income tax cuts flowing through, the monsoons have been good, inflation has been trending down, which increases the ability of the wallet in individual hands to spend more. Then, going forward, we are also likely to see next year, at some point of time in CY26, payouts from the 8th Pay Commission also benefiting consumers and individuals. The government has started this reform process with rationalization of GST slabs. We believe, and as has been announced in multiple forums, that the reform process is likely to continue and accelerate going forward. So that is going to lend positive macro news flow. Also, we are seeing a pickup in government capital spending. In Q1 FY26, government has spent a lot on capex. We would expect this trend to continue. So yes, while the global environment continues to be uncertain and there is overhang of tariffs, the Indian domestic economy, in our view, is on solid grounds, and we are positioned to benefit from a recovery in H2, starting from the festive season onwards.
Right. That's a fairly positive assessment of where the economy at this point of time stands. Crossroads, literally. The government, along with the RBI, has done all that it can to create a base for corporate India to take the baton forward at this point of time. Now it remains to be seen, how corporate capacities come up, how EPS growth sets in. Be that as it may, Mr. Bansal, we were going through your portfolio, and all three of them, which is ASK Growth, ASK Lighthouse, and ASK Special Opportunities, have a distinct large cap tilt. In fact, ASK Growth, which is now 24 years old, has 70% weightage in large caps, predominantly banks, as well as, for the lack of a better word, some very strong PSU names such as Coal India, NTPC, to some extent, even State Bank of India. Could you please share with us the logic of creating these kind of portfolios at a time when small caps and mid caps have led to creation of wealth?
Sure. So, Shailendra, all the three portfolios that you spoke about are flexi cap portfolios, wherein we definitely keep a certain minimum percentage of large caps. Having said that, as a basket, we are more comfortable with large cap valuations than mid and small cap. This is not to say that every mid and small cap name is overvalued or there are growth concerns, but for the pack as a whole, we would like to believe that that is the case. Hence, we are more picky and choosy while selecting names in the mid and small cap basket. Within the large caps, we are really positive on the banking and financial space. Private sector banks, we have a lot of valuation comfort. Yes, credit growth is currently slow. We would expect a pickup in credit growth from the second half onwards. There is margin on NIM compression, which has happened in Q1. It is likely to bottom out from a margin perspective in Q2 in our view. Asset quality has relatively held up quite well. Hence, as and when credit growth picks up, given the attractive valuations that large private sector banks are currently trading at, we believe that there is a very good value creation opportunity from here onwards. On the PSU bank side also, we are quite positive on select relatively large sized names. Because we believe that they will also benefit from a pickup in credit growth. Therein also the asset quality has held up relatively well. While PSU banks are more attuned to lending towards the corporate sector, we think that corporate capex is also going to pick up in a few months' time. And this confidence is lent by the fact that capacity utilization levels are close to 77-78% kind of levels. If GDP growth is in the 6 to 7% kind of a ballpark, then over the next couple of years, capacity utilization levels would really reach very elevated marks, and corporates would need to start to invest as soon as they see some pickup in demand. Anyways, a lot of corporates have raised capital. Promoters have raised capital. Private equities have exited in a flush with funds, and banks are willing to lend anyways. So the entire BFSI pack, we are quite positive on. As far as some of the names that you spoke about on the PSU side, those are more on the thematic portfolio that we have, which is Lighthouse, which is like a business cycle fund. And that fund is focused on four themes. Those themes are manufacturing, infrastructure, energy, and defense. And so we do have a lot of names on the utility side, on the energy side, which are from the PSU basket over there. Net, our comfort on valuations, given the robustness of the growth profile, is more on the large caps, and our stance is more selective on mid and small.
Right. Mr. Bansal, if I may, are you buying comfort in valuations rather than hunting for growth? The reason why I ask this is that traditionally in India, we've had growth portfolios, growth fund managers who have outperformed value for a very, very long time. I mean, are you opting for comfort rather than risk? This is just a broad brush on how your portfolios are constructed.
So that's a very interesting question, Shailendra. I'll tell you the way we think about it. So the market EPS growth, or let's say Nifty EPS growth from FY21 to 24 was around 20% CAGR. At that point of time, anything and everything was delivering, broadly speaking, very good growth levels. FY25, we saw 5% growth broadly. FY26 is again likely to be a year of, let's say, around a double digit 10% kind of growth levels. So our view is that broad-based earnings growth is unlikely to be the story going forward as well, and growth is going to be far more concentrated and only in a select few pockets. Hence, our focus continues to be to bank on those names, but also being mindful of valuations at the same time. Equities as an asset class offers growth, and investors come to this asset class for growth. And hence, our style, our choice, our preference is always going to be for businesses that grow fast. But what we are focused on is sustainable growth, robust growth, and also businesses that are available at reasonable valuations. If we look at the market overall, Shailendra, currently it is trading at around 21 times a 1 year forward, which is broadly the average for the at which it has traded over the last 10 years. From here onwards, our view is that markets are likely to offer more of compounding kind of returns, though there could be returns that could emerge from re-rating as well, and re-rating of multiples could happen if global macro news flow turns positive, let's say in terms of tariffs or trade deals, etc., or there are a slew of domestic reforms. Right. But in our base case expectation, we do not want to build in re-rating kind of returns, and hence we are focused more on earnings growth and solid earnings growth.
Yes, if you look at the ASK growth portfolio, which I believe is the flagship product, you manage somewhere like 1300 crore rupees. For the last 24 years, Mr. Bansal, the CAGR has been 18% a year. Essentially, it means 1 crore rupees is 57 crore rupees. Thumb rule. Now, tell us what caused this performance. Was it earnings growth? Was it long-term compounding and remaining invested in frontline counters? What was the how should I say, the secret sauce for this 18% CAGR, which essentially means every 4 years the money doubles?
So actually, Shailendra, it was a mix of all of this. We focused on businesses which were growing far higher than the underlying economy. So that was one. Secondly, we were investing only in businesses that were high quality in nature. What we mean by high quality is businesses that are backed by solid managements, businesses that have robust balance sheets, and businesses that have a high return on capital. So it was a combination of high growth, high quality, and also investing for a long period of time. Our investment horizons have generally been 3+ years. So the idea was to invest through economic cycles, through interest rate cycles, through business cycles, and benefit from the inherent compounding nature of the businesses. The last thing is that we generally invested in businesses that were leaders in the respective segments. They could be growth leaders, they could be market share leaders, they could be visionary leaders, or they could have innovative business practices. Some or the other aspect which led to strong value creations for the business, and then which flew through investor returns. So that was the broad strategy that we followed in growth. Also, it was a diversified portfolio which invested across different sectors of the economy and across different market caps. And this is the same strategy that we continue to follow even now.
Okay. See, basically, I don't think so. The fundamentals of investing ever change. Buy quality, hold quality, buy it at a bad time, look for earnings growth, and let the magic of compounding work. They have been, always there. And as we were discussing before the show started, ASK has been one of the cornerstones of this philosophy over a very, very long period of time. Mr. Bansal, at this stage, what do you think of small caps and mid caps as a sector? They've given multi-bagger returns on indices. Many stocks have gone up by 50, 70 times. And great wealth has been created in India on the Lal Street in the last 5 years. Is this a time for pause? How are you? What exactly are you looking at in mid caps and small caps when you put in client money?
So, Shailendra, I think it is a time to be selective. We've broadly seen a one-way rally. Obviously, there have been ups and downs, but generally speaking, the markets have been very kind as far as multiples are concerned, given that growth itself was very good. So while the rally was quite broad-based, I think now it is the time to be far more selective. And the reason for that is that growth itself is unlikely to be as broad-based as it has been over the last few years. Hence, as fund managers, we would need to choose and identify those businesses wherein growth can sustain over a period of time. So firstly, I think growth is not likely to be as high as it was in the past. Secondly, growth is not likely to be as broad-based or widespread. But will there be pockets of good growth and continued good growth for a period of time? The answer to that is also yes. What we've also seen in the last 1.5 years of market consolidation is that select names in the mid and small cap basket have corrected and valuations have become reasonable. So we at ASK are backing those names, and these are across different sectors. They could have fallen because of either a bad quarter or bad macro news flow or some near-term concerns. But there are enough ample opportunities that are available in that basket, even in today's market environment.
Okay. Now let's shift to a sectoral focus. Mr. Bansal, in the last 4 years, we've seen a very, very strong round of consolidation in the cement space, two large players have gone bigger and bigger. Now, is the stage set for a nice rally in this sector? A lot of your portfolios reflect quality large caps, mid caps from the cement space. What is your gut feel about earnings growth in terms of top two companies, top five companies, and of course, is there a compounding candidate in this sector?
So cement as a space we are quite bullish upon. It has very good representation across our portfolios. This is one of the ways that we are positioning ourselves for a domestic cyclical recovery. Cement is a good play on real estate, construction, infrastructure build out. Uh, the benefits of consolidation in the sector have not yet played out. This we would expect to play out over the next few years, and hence it's yes, it is a very good long-term earnings growth story in our view. If you look at FY25 margins or EBITDA per tons of cement companies, they were far lower than what they had achieved a few years ago. And we believe that margins have a lot of scope for expansion. That expansion is likely to be driven by benefits, not only by benefits of consolidation, but also from cost efficiencies, given that there is a relatively new entrant in the space uh, who is tightening the belt for as far as costs are concerned. The entire sector is on that spree of cost reduction. They're investing heavily in many aspects like logistics, renewable power, etc., which is going to bring down costs. And then there are player specific strategies of brand building, etc. So, yes, this sector is going to benefit from GST rate cuts, from price increases due to consolidation and cost efficiencies.
Okay. Uh, Mr. Bansal, the other issue that is faced by the Lal Street as also by corporate India is this downgrade of IT, whether it's artificial intelligence, whether it's a slowdown in hiring, whether it's lack of guidance. No matter how you look at it, this sector is in pain, and the pain seems to be accelerating. As a fund manager, are you hunting for value here, or are you looking for the worst still to happen? What is your view on the software sector?
So the IT services space in general, Shailendra, we are cautious on. Yes, stocks have come off, which have made valuations quite reasonable. In this sector, management quality, corporate governance standards are top notch. These are high free cash generating businesses, returns on capital, etc., is very good. But unfortunately, there are huge concerns on growth. There are issues around visa restrictions in the near term. Longer term, they are Gen AI related concerns. In the medium term, there are concerns around discretionary spending in the US, whether that will pick up or not. Hence, we have a very cautious view, and we are underweight across our portfolios on this sector. Could there be tactical trading kind of opportunities given where valuations currently are? Possibly, yes. But we being more long-term oriented investors, we are more focused on long-term compounding and sustainable earnings growth, which we believe this sector, given the various concerns on growth, given that it's a relatively mature sector which has done well for 2 or 3 decades, it's unlikely to come through in our view. Hence, our stance remains on being underweight the sector.
Okay. Uh, Lastly, how do you see this GST rollout working out in terms of rejig? Two sectors you think that will be the top beneficiaries of this recalibration of GST rates, as also one that might bear the brunt?
So, firstly, the entire macro picture of this GST rate rationalization, in my view, is very good. This is, in some sense, a very big reform that the country is undertaking, and we would not necessarily look at it only as a short-term fiscal boost. It eases a lot of things in terms of business, ease of doing business, etc. It boosts consumer demand. Uh, it gives a very good support to the domestic economy. All the sectors which were in the 28% kind of bracket, which will go down to 18% levels, will benefit from that. Cement and consumer discretionary are the top two sectors which will benefit from this rationalization, in our view. A sector which could get hurt are, let's say, maybe spaces which will move from 28 to 40% kind of slab. Overall, what we think is that this is going to have a lot of macro implications as well. It is going to help consumer consumption in the relatively lower strata of society, because prices will come down. It will also help inflation, and maybe it will help RBI later on to think more about rate cuts in the future as well. So we look at it not only from a near-term perspective of boosting demand, but we think it is a big structural reform that has been undertaken in the country.
Okay, fair point. And a view on defense. The reason why I asked this is that, social media, investment themes, everybody is abuzz with how defense spending is rising, how this is a secular story. And the 6 PSU defense stocks have given multi-bagger returns for the last 5-7 years. It has been a top magnet draw for fund managers. Yet at ASK Investments, whatever partial portfolios we peek into, there is no presence of defense. What keeps you away?
So, Shailendra, we actually have a good exposure to defense in many of our portfolios. And we have a fund called Lighthouse, in which actually one of the themes is defense. We are quite bullish on the sector from a long-term perspective. We believe that defense spending and investments by countries across the world is likely to remain high for a long period of time. In India, there are the added benefits or tailwinds emerging from indigenization or Atmanirbharta. Plus, there is an export opportunity which has also opened up. In the defense sector, till a few months ago, there were concerns around valuations. Yes, growth is going to be good from a top line perspective. Margins have already become quite good and might remain at elevated levels. But at some point, valuations come into play. And hence, we had reduced our positions on defense because we felt that valuations were quite elevated. Stocks have come off now. Valuations do seem far more reasonable. So we are on the lookout, and at appropriate levels, we are looking to participate more in this sector, because we believe that the runway for growth is really for a long period of time.
Okay. Mr. Bansal, my final question to you is on this broader PMS theme. I think there is a growing body of evidence which shows that PMS fund managers have been maybe on the back foot in terms of returns being generated over the last 4 or 5 years. That's primarily on account of the rally that's come into mids and smalls. Many of the top marquee schemes have underperformed even broader indices. What do you think ails this sector at this point of time? A lot of people are really disappointed in the top 2 or 3 names that have been, dominating social media, dominating investment discourses.
So, what I would say on this, Shailendra, is that whenever there is there have been, there have been schemes which have done well as also. Secondly, if we look at the markets over the last 3, 4 years, there have been a very broad-based kind of rally, wherein different sectors and different stocks have done well in turns through rotations, etc. PMS approach is relatively more concentrated, wherein schemes in general would be having, let's say, 25 to 30 kind of stocks. Also, PMS managers might not want to change their portfolios as frequently, and the views might be more on a longer term basis. Fourthly, PMS schemes would be far more divergent than their benchmark indices. What we've seen in the markets is that benchmarks and portfolios which might have been closer to the benchmarks might have done far better. Fifthly, PMSs generally have their own philosophies, and philosophies could take time to play out, especially in one-way raging kind of bull markets where the rallies are quite broad-based. So that could be one of the other reasons to for the performance that you might have seen over the last few years. But my sense is that over a period of time, if a fund manager is aligned and diligently follows the philosophy that has been stated, uh, and the philosophy is well understood by the clientele, over a long period of time, if the businesses that are selected are quality high growth businesses, they should get reflected over a period of time. So what might have been the case previously might not remain so, and then there are phases in the markets where different styles and different asset classes perform or go through a period of underperformance.
Yes, sir. I think the beauty of markets is that at any stage in our career, there is a parallel bull and a bear market ongoing in different sectors on the same platform. Be that as it may, Mr. Bansal, what a pleasure. And let's hope that the latest project that's been launched, which is the Spotlight series, does very well in a country where growth is preferred but value also outperforms. Thank you so much for your time, and here's wishing you the best.
Thank you so much, Shailendra. Thanks a lot.
That, ladies and gentlemen, was Mr. Sandip Bansal, the CIO at ASK Investment Managers. He looks after three basic PMSs, which is ASK Growth, ASK Lighthouse, and ASK Special Opportunities Fund. In all, he manages about 4,000 crore rupees, has a distinct large cap tilt, and is looking at the GST rejig, growth coming in back from Q3, and of course, better compounding, better earnings growth in the quarters ahead. Thank you for watching. I'll be back at 2 p.m. with an equally spectacular guest to discuss the way forward in markets. Have a nice day.